I'm going to teach you something that no school's ever taught you before. Are you looking to retire in your 40s or 50s? Are you not investing enough into retirement accounts because your mentality is that if you can't withdraw from your 401k, TSP, or IRA until you turn 59 and a half, why invest so much now? And the reason I hear from people, the most common reason anyway, not investing into their retirement is that they think they're either gonna die way before 59 and a half, or they just have too much in expenses. And what if I told you that you have the option to withdraw from your 401k or TSP completely tax-free and penalty-free before 59 and a half? Would you invest a lot more into your 401k, TSP, and IRA now? And this strategy is called a 5-year conversion ladder with the Roth IRA. If you're brand new to my channel, my name is Sai, and welcome to my channel. I want you to grab a pen and paper like me right now, because if you don't do the 5-year conversion strategy correctly, you could end up paying 10% in penalty and a lot of money in income taxes. So in this video, I'm gonna go over what accounts you need to open for the Roth IRA conversion ladder, how the conversion ladder works with taxes, and how much you need to make this strategy work for your early retirement. Just keep in mind that this is not a one-size-fits-all strategy. How much you convert will depend entirely on your expenses during early retirement and the size of your portfolio. And you should check out the video I made about our plan to withdraw $2.8 million from our investment portfolio, because this video is kind of a sequel to that video, and I will link that video in the description below. So here are the accounts you need to make the Roth IRA conversion ladder possible. You need your employer sponsored retirement account, a traditional IRA, and a Roth IRA. And it's better if you have both traditional and Roth IRA with the same broker, but you don't have to. I think it's just easier with the conversion process, but I will go over those later in this video. So your employer sponsored retirement account is your 401k, TSP, 457, or 403b. They're all essentially the same. It just depends on the type of employer you have. So 401k is common with the private sector, for-profit companies. TSP is for federal employees or members of the armed forces. 403b is more offered by nonprofit organizations, and 457 is offered by state and local governments. Sometimes you could have both TSP and 401k if you're in the military on a part-time basis, like Guard or Reserve, and you're working for a private company at the same time. You might have all 3 types of employer or 4 types of employer-sponsored accounts because you've had several different jobs. Let's make things easy and say you have a 401k account with your employer, and what you need to check is to see if you have a Roth 401k or a traditional 401k. So if you don't know the differences between Roth and traditional, then you can check out this video, and I will put the link in the description below. Your employer match or contribution will always be in the traditional account, and your contribution is what you elected to do when you started working for that company. If you only have the Roth account, then you can't do the conversion strategy. If you have the traditional retirement account, whether it's 401k, TSP, 457, or 403b, then you can do the conversion strategy. The next 2 accounts you need are your traditional IRA and your Roth IRA. And keep in mind that this is not the same as SEP or simple IRA offered by your employer. And you can again check out that video on to understand the differences. Your IRAs are the account you typically open with Chase, Schwab, Fidelity, or any broker that offers IRAs. Now let me go over some of the key terms here so you don't get confused with the conversion ladder strategy. I talk about the 4 key terms every time I talk about the Roth IRA: contribution, conversion, earnings, and rollover. This video is all about conversion. A contribution to your Roth IRA is what you directly contribute or transfer from your bank checking account to your Roth IRA. A conversion is when you decide to pay taxes now on what you have in your traditional IRA or other pre-tax retirement accounts, and then you convert that money you pay taxes on over to your Roth IRA. So anytime you do a conversion, you'll have to pay taxes on the total conversion. A rollover is when you directly move money from traditional to traditional or Roth to Roth. So in this case, from Roth 401k, Roth TSP, or other Roth accounts directly transferred to your Roth IRA, and you wouldn't have to pay any taxes on the rollover because you already paid them. It has to be a Roth to Roth rollover so the IRS can't tax you twice. You can't do a rollover from Roth to traditional because you already paid taxes on the contributions. Earnings in your Roth IRA are however much you earn from investing in a mutual fund, ETF, bonds, stocks, or other qualified securities in accordance with the IRS. You cannot withdraw your earnings and interest until you turn 59 and a half. You can, however, withdraw your contributions at any time and conversions after 5 tax years, and I will explain more about that later in this video. By the way, you can get our free fire resources by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop, and I have all of my stuff on my bookshelf at firesidechat.com/shopping. Now let's talk about how the 5-year conversion ladder works and how you can withdraw your Roth IRA conversions penalty-free and tax-free. First, we need to figure out what our annual expenses will be when we retire early. We're going to retire at 45 and we would like to have $100,000 a year in passive income. Our strategy is to have our dividend stock portfolio supplement our income during early retirement. And I did a detailed video on the dividend investing strategy, and I will put that link in the description below. Second, we need to figure out how much taxes we're going to pay for the conversion. The qualified dividend tax rate in the year 2022 is 0% if the taxable income is under $83,350. I think the income cap is going to increase over the years, and we'll just say it's $90,000 by the time we retire in the year 2032, and that probably includes the standard tax deduction. So our goal is to withdraw $40,000 a year in dividends from our taxable brokerage account and convert $50,000 a year from traditional IRA to the Roth IRA. That $50,000 conversion is going to be taxed based on the federal income tax bracket that we're going to be on. And since we're going to be still married, and filing taxes jointly, the first $20,500 will be taxed at 10%, and the next $29,500 will be taxed at 12%. So we will end up paying $5,590 in taxes for the conversion, and this includes the standard tax deduction of $25,900. Keep in mind that I'm using the 2022 federal tax bracket, so I would guess the deduction will continue to increase over the years. We're also not doing a conversion until we quit our jobs. Here's the reason why. Our strategy is to create passive income and not have to work the 9-to-5 job, right? So let's say we make $200,000 a year and we do the $50,000 conversion at the same time. Our marginal tax rate would increase from 22% to 24%, and the effective tax rate would increase from 17% to 18.5%. That's an additional $12,000 in taxes. We want to minimize our tax bill as much as possible, and we can't do that until we quit our job and significantly decrease our taxable income. We will live on dividends and capital gains to pay for our expenses during the first 5 years of the conversion process, because the capital gains tax rate is significantly lower than the income tax rate, which is at 0% or 15% for us. Please keep in mind that our tax situation is different from yours, so please get with a CPA to figure out what your taxes will be during your retirement. We're filing our taxes jointly, and you might be filing yours as single head of household or separately as a married couple. However, if you need help with creating a financial strategy, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. Now that you have your taxes and annual expenses figured out, here's how it's going to work. First, I'm going to quit my job. That's pretty simple to do, right? Second, I'm going to roll over my entire traditional TSP or traditional 401k to traditional IRA. And keep in mind that this step is just a rollover, and so the conversion hasn't happened yet. In my experience, the rollover takes about 3 to 4 weeks, depending on the brokerage company. So let's say I have $500,000 total in my traditional IRA after all the rollovers. Because in 5 years, I need $50,000 a year in expenses, I'm going to convert $50,000 every year for the next 10 years. Your 5-year conversion strategy will depend on the size of your portfolio and your annual expenses by the time you reach your retirement number. If you only have $100,000, then you probably have $20,000 a year to convert for 5 years. If you had $1 million, then you could strategize it to where you could have $75,000 a year for 13 years. You have to keep the taxes in mind though, because you don't want to convert too much to end up paying more taxes than you have to. So when I convert $50,000 in the year 2022, I have to wait until January 1st, 2027 to withdraw the $50,000 completely tax-free and penalty-free. And it doesn't matter when in 2022 I convert the $50,000. It just needs to be anytime between January 1st and December 31st, and the 5-year clock starts on January 1st regardless. So if I converted, let's say $50,000 today on May 11th, then I can withdraw the $50,000 conversion tax-free starting on January 1st, 2027. So I want to keep the ladder going, right? I want to withdraw $50,000 tax-free every year during our 15-year early retirement from age 45 to age 60. So I'm going to pull this spreadsheet here and show you from the year 2032 until 2047. And that's the 15-year early retirement for us. In 2032, 33, 34, 35, and 36, these are the years we're not going to have any income from our Roth IRA conversions, right? So what we'll do during these 5 years is to live on dividends, capital gains, and other sources of income. So when we get to 2037, then we can stop withdrawing from some of our taxable brokerage accounts and instead just withdraw the $50,000 we converted from 2032. This is going to reduce our income taxes because that $50,000 won't be taxable. Just keep in mind that only the contributions and conversions are not taxable. We don't want to touch the earnings until we turn 59 and a half. And then when we turn 59 and a half in the year 2047, we can withdraw everything from our Roth IRA tax-free. And keep in mind that the 5-year rule still applies even after you turn 59 and a half if you did the conversions, but we'll have enough earnings and contributions that we can live on. By the time we turn 60, we're projected to have $4.5 million in our Roth IRAs, and I did a detailed video on our investment projections, and I will put the link in the description below. Our withdrawal priority will always be taxable accounts and then the Roth accounts. We want our Roth accounts to grow tax-free as much as possible, as long as possible. Okay, let's sum it up. You have your employer-sponsored retirement account like 401k, TSP, 457, or 403b, but it needs to be in the pre-tax or traditional account, or you won't be able to do the conversion. If it's already in the Roth, then all you can do is the direct rollover to a Roth IRA. You need to open a traditional IRA and a Roth IRA to make the conversion happen. So I would recommend you open both of these accounts with the same broker to make the transfer faster and easier. So keep in mind that for every dollar you convert in 2022, you can withdraw tax-free and penalty-free starting on January 1st, 2027. And then you continue the conversion ladder every year, even after the 5th year, when you can withdraw that conversion. So your overall strategy will depend on your annual expenses during early retirement, your total taxable income from other income sources during retirement, and your early retirement age. This is why I encourage everyone to maximize their retirement now so their money will grow so much more in 10, 15, or 20 years. I would also suggest that you get with a CPA if you have a complicated situation with taxes. And if you want to know more about how we're going to have multiple sources of income when we retire early, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.